Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. And I'm Ed Cox with Magnolia Wealth. And we're almost through, halfway through November, almost through the year now. It's been kind of a bumpy road this year. We've had volatile markets. The S&P currently sits at around down 17%. We've seen it down in the negative 25% roughly this year. And so we've gotten a little bit of bounce recently off some economic news that that inflation may be kind of topping out. We'll talk about that later. But I thought it was a good episode maybe for us to go back and look at history being invested in the market and kind of some rolling periods and what that has shown us. And then maybe looking at some diversification and why we stay diversified through these periods. So I'm going to share my screen, and then hopefully these slides will give you a little bit of comfort in a year that's been tough. It has been a tough year in the market. There's really has not been a place to hide, which we'll see here in a little bit. But let me share my screen. And so this first slide is showing time, diversification, and the volatility of returns. So it's saying, it's showing us here a 1 year period, 5 year rolling periods, 10-year rolling periods, and 20-year rolling periods, starting from 1950 going through to end of last year, 2021. And it's broken down. Each of these segments in time are broken down: stocks, bonds, and then a portfolio of 50%, meaning 50% stocks, 50% bonds. Okay. And so if we look at any given 1 year, we're just looking at each individual 1 year period from 1950 to 2021, we see the worst year being negative 39, best year being 47%. Bonds, best year 43, worst year negative 8. The combination 50-50 portfolio being best year 33, worst year negative 15. So there's big disparity between those two. We see some pretty big downturn years. We've seen some really good up years. But overall, if you look at any given 1 year, you start seeing that, there's a lot of disparity between years from 1950 to 2021. Then we look and see, all right, what if we look at 5 year rolling periods? So this is 1950, 1954, and then 1951, 1955. So that's how that works. It's each rolling 5 year period. Okay. We see that a lot of the down or negative year pressure goes away just by extending from looking at 1 year versus 5 years. Okay. And then the further you get down this graph, you really start to eliminate most of, if not all of, your downturn or downside years. If you go 10 years in stocks, there was a 10-year period where worst case was negative 1%. Bonds would be 1%, and a balanced 50-50 portfolio would be 2% annualized return over that period. So, and then when you go to 20 years, you eliminate all negative returns during a rolling 20-year period. But really in the 5 years, kind of the biggest jump between 1 year to 5 year, you almost eliminate pretty much all of your downside risk. There is some, but pretty much all of it. So what this is saying is from 1950 to 2021, staying invested at least 5 years reduced your volatility by a pretty good margin. And I think it's always good to look at these type of graphs and information to put things into perspective. Okay, because this year we're looking at one of these where the disparity between typical returns and where we are is pretty big. So the next graph, though very busy, I understand, it shows each individual year starting in 2007, and it shows the different asset classes. So you have emerging market equity, commodities, domestic equity, and then the white, what this is showing, is a asset allocation. So being diversified. And you can see an individual year what the returns were in each of these categories and where they ranked amongst the others. So if we look, a lot of times people would say, well, hey, that small cap did real good in 2013. Let's move our money to small cap. Well, the next year it didn't do so good, didn't do as good. And then the year after that, it did even worse. And then come back up to so trying to time and think I should be in this asset class versus that asset class can be very tricky. And just because it was really good this year doesn't mean it's going to be good next year. And just because it was the worst the year before doesn't mean it won't continue to be the worst next year. So it's just an interesting graph, but shows that asset allocation, being diversified, really reduces your risk over time and keeps your volatility a lot lower. I just thought this was a really good graph and shows an interesting way of looking at all of the different asset classes typically that you see in a portfolio. So you can see this is year to date, kind of how things are shaping out. And commodities are up, cash is flat, and then pretty much everything else is down. Even fixed income, which is your bonds, asset allocation, which would be a mix of all of these, high yield, everything here is down except cash and commodities are up. So it's been a pretty rough year. You can see from that. But once again, this is a pretty good graph, pretty good illustration for us to look and see how asset allocation really balances out our risk and keeps volatility low. Y'all, I hope this has helped. I know some of you throughout the year, this has been a tough year for you. You may be retired and you've seen the market go down and wondering, golly, what's going to happen? Remember, we've put together a plan. You have a financial plan that is designed for these type of events. We knew that this was going to happen. It will continue to happen in your retirement. We don't know exactly when these events will happen, but we do understand that just because we retire, we're not going to all of a sudden just get positive years for the rest of your retirement. We know markets expand and contract, and we'll go through really good markets, and we'll have some bad, rough patches along the way. But your plan was built for this. Stay the course. Remember that there's a plan in place, and remember we're here to help you. So if you have any questions, always call us. Y'all have a great Thanksgiving. God bless. We'll talk to you later. Bye-bye.